What's going on? Welcome to another episode of the Impel Forward podcast.
Yes. We got a special guest I'm super excited about. I'm actually excited about all of our guests, but again, as before, it says something about community, right? When you reach out to an individual and you say, hey, I want you to put the people on, I want you to, talk about your life experiences. Can you do that for me? And it was immediately yes. And I just love that. I just love that in the community that I built, that they trust me enough to want to come on and help the people and help me help them. So I love that. I want to introduce a good friend of mine, his Mr. Ant.Holt. If you don't know Anthony, I don't know where you live. If you are in North Carolina and you don't know Anthony Holt, Mr. Holt, then you're living under a rock. Let me just kind of give you a little bit about him. He is a graduate of NCCU. He has a degree in criminal justice. That's where you and I click. I also have that. He is a member of Omega Psi Phi. He's a Q. So, of course, you know him. He's a Q. Also, he is in the mortgage industry. Again, that's where we kind of match up. He has been a branch manager and in the mortgage business for how long? Over what?
25 years.
25 years.
Yep.
And ladies, he looked young, don't he?
Plucking the grays.
Don't let the years of experience fool you. He
You start when you was 18?
Huh?
You started when you was 18?
Hey, look. Since I've been out of Central, I had to figure it out quick.
Well, that's about 22, 23, somewhere around there.
It's been some years, but he is a wealth of knowledge. He has, ever since I've known him or I first met him, he has brought something to the table, whether it's understanding home ownership, it's buying a house, it's making your money work for you. He's always willing. And let me tell you something about this man. And I'm be very clear to our audience. He is a straight chaser. He don't hold nothing back. He gonna tell you what it is. And I mean, sometimes his delivery is his delivery, but let me tell you something. You're gonna walk away with something.
Very
And
direct.
that's Anthony Holt right there. As a whole.
Very direct. Definitely very direct. Nobody will accuse me of being anything other than
Nothing.
Well, good. Let's get it. Because these people got a short attention span sometimes.
Yeah. Yep.
But we're gonna backtrack to it, but we're gonna jump straight into it.
All right, let's go.
Let's talk about this 8 to 15,000 funding for first-time home buyers.
And I stand corrected because let me tell you something. Anthony reached out to me this morning. He said 8,000. Please, if you want to be specific, let the people know up to 15. I said, oh, okay.
Yeah. So a lot of times when we talk about down payment assistance programs, they come with different rules, different guidelines and stipulations. But the one that Renee was referencing is one that's totally in-house, and it comes with a lot of restrictions. So I don't really promote it too much. It's one that kind of goes off of where you live and then where you're going to be living. And so the product is very limited to certain geographic areas, none of which are right here in our service area in North Carolina. So I don't really promote it that much. The 15,000, definitely, that's a North Carolina housing down payment assistance program.
Well, that's
we love. Yeah. More money. So we definitely promote that a lot more than any of the other products. We do have a nice suite, but let me backtrack. We're going to get to that. So what I like to, since you said some people have short spans, I want to start off by saying that I work for the largest privately held, this is a mouthful, minority owned mortgage bank in the United States. So people will ask, well, or call me a mortgage broker. I'm like, I'm not a middleman. I'm not a broker. We are the actual source of the funds.
Yes.
So no mortgage broker. When you deal with me, we have the underwriters in my company. We have the underwriters, the closers, the funders, everybody that's part of, your buying process on the money side is all in-house. So we do everything, and we only do mortgages. That's it. So we're very good at what we do because that's all we do. That's what we specialize in. But yeah, so the 15,000, that particular loan is done through what we call North Carolina Housing Finance Agency. And it's a wonderful program. I mean, I tell people, when they call me, I'm a very good listener. I ask a lot of questions because at the end of the day, I have to make sure that you are getting the proper product and being placed in the right loan for you and your needs and your goals. And so you'll find that a lot of people in my profession, they don't ask a lot of questions. They let the client actually dictate everything, which is basically, if you're going to tell me how to do my job, then fine. We're not going to jive very. That's almost like you going to the doctor and saying, hey, listen, my heart's palpitating. Give me an aspirin. All right, cool.
Right. Right.
You got it. Since you diagnosed yourself, you got it. So I like to ask a lot of questions, make sure that we're getting you in the proper loan product for your needs. But yes, so that product is very, very easy to do. We do a whole bunch of them. You need 3 years tax returns. And for most of my folks, these are the folks that I do this for. If you have a 640 credit score and you tell me, hey, Anthony, listen, I only have $2,000 or $3,000 to my name. When I get my tax return, that's all you got to work with. Then we're probably going to be looking at that product. If you tell me, hey, look, I'm not a veteran and you're not buying within what we call a rural area. For the rural areas, you have what's called USDA, just like, the milk, the farm, cows, moo.
Right.
It's called rural development. They do 100% financing as well. And it's just one loan. Whereas the 15,000, we're basically taking the funds and we're combining them with a loan product like in what we call a FHA loan, which is a government-backed loan. I love FHA. Very, very easy. If you have less than perfect credit, that's the way to go. Or if you have what's called debt to income ratio issues, not making as much money, right now, times are hard. Everything costs way more than it used to. So if you have, some credit challenges, some dings, some dents, that's not the end of the road for us. We are very well known for digging and trying to make loans happen. The one thing about, my company is we understand that minorities have challenges that other folks just don't.
Right.
So being a Latina, having an owner of your company that's Latina, she already understands that Black and brown people have unique sets of challenges. So for us in our community, at the dinner table, we're not taught about finances.
Right.
Exactly.
I mean, let's just keep it a buck. Most of us are the first people to own homes in our family. My grandmother lived in the housing projects in Yonkers, New York. My biological father is still renting, living on the Hudson River in New York. My mom and my step pops, they are the first homeowners that I've ever known. Once we moved out of New York, they struggled in a little apartment and got their funds together and decided they wanted to build their first house. So they're the first homeowners that I know in my family.
Wow.
So we never talked about finances at the dinner table. I had to learn this thing as I went, 1998.
Yeah. Once you got into the mortgage industry, right, is you start seeing things and you're like, oh, this is attainable. What have I been waiting on? Right.
Yep. It's very real. Leon, I was going to tell you, we have, sometimes when I do like these home buying seminars, I did one in Greensboro. So by the way, I live in Durham for those of y'all that don't know. But I did a home buying seminar with a builder and an agent out in Greensboro. And for a split second there, a lady asked, she said, how young is too young to purchase a home? And I was telling her how I just had a 21-year-old entrepreneur. He owns a trucking company. I just closed him last month.
Oh, yeah.
Yeah. You know what I'm saying? Young kid. But 18 is basically where it's at. But I was telling her, I said, y'all think about this. For everybody on here that went to college, we got those big refund checks. These kids are out here blowing these refund checks on Dodge Chargers.
Right.
Whole entire wardrobes, right? Let me tell y'all, the thought that went through my mind during this seminar was like, imagine if we took just 10 of these kids that actually got along with each other and we coached them like, okay, so next semester, when you get that $10,000 refund check, how about this? How about we go look at property and we look at doing what's called a hard money,
Yeah.
fix and flip deal. I hooked them up with all the general contractors. They all, as a collective, decide, okay, I'm willing to pitch in $5,000, $6,000, whatever. We're not going to buy clothes and cars this semester. And we go out and we look at property and we find one. Something that's just simple. Let's put some paint, some flooring, some new hardware. We buy it at a great price and we turn right back around and sell it. We can split the profits 10 ways, or we can put it right back in the pot and let's do another project. I literally had these young kids that don't look like me and you, that were part of my car club. These boys are driving $400,000 and $500,000 cars. And I'm like, what do you 22, 23-year-old boys do for a living? Oh, we flip houses. We flip houses.
That's big.
You went to college? No.
Right.
Like, who taught y'all this? My mom and my daddy. But y'all got to think about it. In the Black community, what are we taught? When we buy our first home, what are we taught?
What are we taught?
Pay it off.
Pay it off.
Pay it off.
That's the goal.
Yeah.
Become debt free. Pay it off.
Zero
balance.
So you think
that's what?
Go ahead.
That's what we're taught. Buy a house to pay it off. That's it. Whereas other communities are taught, buy the house, get the equity, use the equity. We call it a home equity line of credit.
Right. HELOC.
To go buy another house.
Right.
An investment property. So in my house, I live off of Ellis Road. I bought this house 3 years ago for $385. And so at the height of the market, this thing skyrocketed for $600 to $647,000. It's right off of right where the Sheets is, y'all. Y'all know where Ellis Crossing.
Yeah.
You know what I'm saying? So the thing went up to 647. It's not 647 anymore because the market cooled down a bit. But still, if you went out and took out a home equity line of credit at the height of the market, the difference between 385 and 647 is a lot of money.
Yeah.
So, I'm the kind of person, I'm going to tell you, if you call me, I'm going to give you the best advice. It's not always about me doing the actual loan. I'll tell you, Coastal Credit Union does 100% financing on home equity lines of credit. Go talk to my two girls over there. Come back to me, and we're going to put a down payment on something else.
Yeah. So that's 5 different loans, right? Is there only 5 different types of loans?
Nah, I wish.
What? So you're saying like the group of people, the individuals you're saying, the young kids that were 5 of them together? Is that what you're saying?
I'm talking about the 5. I seen somewhere there's this 5. So are you saying there's more than 5 different types of loans?
Yeah.
Okay. I thought it was only 5.
Shoot, there's 4 different versions of a 97% conventional loan.
Oh yeah.
Yeah. I mean, like you got conventional, let's just say for at layman terms, conventional for tonight's conversation just means a non-government backed loan. So when I say government backed, I mean FHA and VA.
Okay.
So if you're a veteran, you get a VA loan, 100% financing. I have folks getting $1 million, 100% financing VA loans. Like there's no down payment, $2 million, no down payment. As a veteran, then you have FHA, then you have conventional. So if you're talking about, are those a type of loans? Then you have USDA, which is a government. I mean, well, they look at it more like conventional, but I think it's sort of like, I don't know properly whether we would call it conventional or government. It has government bureaucracy ties to it, like anything else. Then you have what we call non-QM or non-conventional. So jumbo. So the non-QM, or what we call non-qualifying mortgages, those are those specialty mortgages that we used to see back in the day. So for example, if I have somebody who is self-employed, most of them, I don't want to invoke Trump, but he's the king of writing stuff off, and burying wives on the golf course. I don't want to pay any taxes. So for all my folks who don't want to pay taxes, we're on the same page. I don't want to pay any taxes either. But for a lot of our clients, when they come with their tax returns, they've written off so much that they may have done $200,000 in sales, but by the time their tax advisor has, gotten done with them, for our purposes, they look like they only make $30,000 a year.
Right.
I can't put you in a $350,000, $450,000 house with $30,000 a year. So what is the recourse? We have specialty loans, like we have one that's called a 12-month bank statement program. So that means instead of you providing your tax returns to me, you're going to give me 12 months of your personal bank statements or 12 months of your business bank statements. I'm going to use all the deposits from those 12 months. We're going to divide them by 12, and then we put stuff in this little special calculator, and we're going to use that number. So for that person that, brought in $200,000 worth of sales, you look like you made 30 over here, but now for us, you look more like you made 150.
All right.
And now I can get you into the house you want. Down payment is going to be higher. You might be at 15% on something like that, but guess what? It's a more risky loan. It's a specialty loan. You got to take what you can get. You either pay them taxes or you get this loan with the higher down payment, but I can get you into a home.
That's so good. Go ahead.
With the interest rates as high as they are now, and the houses as high as they are now since COVID, do you find a lot of people still trying to buy houses? New owners?
Yeah, so it's a big fight. I'm gonna tell you, the fight is, auntie who thinks she knows what she's talking about interest rates, and then you got, new agents who just popped up on the scene, and then you got, everybody wants to be a financial guru, right? But at the end of the day, we're telling everybody, you marry the house. Follow me, y'all. Marry the house, and you date the interest rate. So,
okay. Expand on that. Marry the house, date the interest rate.
Date the rate. Yep, date the interest rate. So imagine we go back to 2021 when all of our folks who wanted to buy a home were frustrated, to the nth degree, because they put 20 bids in and didn't win not one of them.
Right.
And what they didn't realize is that they were bidding against seasoned investors. They were bidding against hedge fund folks who are buying homes, cash money right then and there.
Banks and stuff.
You can't beat somebody. You can't beat the person who has $400,000 in their back pocket that just moved from California or just moved from New York. They sold their brownstone or they sold their $1 million home in California and they're moving to North Carolina because we're on the top 10 list. You can't beat them. They got cash. They sold their house for $1 million and they're going to come over here and buy something for $500,000 that's 3 times as big as their old house. You can't beat that. So we're telling folks now, while the market is cool, buy right now. Because if you're talking to a good loan officer and a good real estate agent, me and the agent are going to communicate on a very high level. I'm going back and forth with that agent. Like, okay, this is a real life example. I'm going to tell you about one right now. The house was listed for $399,000, right? I looked it up on Zillow. It has a price. It's been on the market for 45 days. It has a price reduction of $20,000. So basically, they started out listing it for $420,000. Right now, over the 45-day period, they've lowered that home price down to $399,000 in hopes that somebody's going to buy it. So my client, I'm telling him, like, listen, with this, because they've dropped this price this aggressively in that short amount of time, I think we have a win. If you love the house, let's be very aggressive. So the agent started out with $399, and we're going to ask for $10,000 in what we call seller concessions.
Mm-hmm.
So that is money that we are going to take away from the profits of the seller. They're going to give it to us. Now, what we do with it, you have a couple of choices. The two choices in this example are we can take the bulk of it and pay his closing costs, which on a $400,000 house, you're going to be very close to that. So in this example, he's going to use that to pay his closing costs. I said, now, if that is aggressive, let's take this in a different direction. Let's take the house price back up. Let's go to $410
Mm-hmm.
instead of $399 and ask for an additional $10,000. What I'm going to do is I'm going to take that $10,000 and I'm going to use it to lower his interest rate. We call it a rate buy down or discount points or points. You've heard it multiple different ways, but we're going to take the profits from the sale and we're going to use it to our advantage. So for somebody who qualified for, let's say 6.875, now he has an interest rate in the mid fives, 5.5, 5.25. And that rate, even though we went up in price, me taking that $10,000 and using it for the rate is going to have a way bigger impact on his payment than lowering the sales price by $10,000. Mm-hmm. So we're talking about saving, $200 a month. Something, it's a big number,
right?
By getting that money from the seller to achieve that task, and that's what's most important. So if we can squeeze out as much money in this market from the sellers, then that's what we're going to do. Now, guess what? When these rates come back down in July timeframe, when the Fed supposedly are going to meet again, guess what's going to happen?
The
house prices are going to go back up.
Right.
Mm-hmm.
Because everybody and their mama is going to get off the fence and come back into the market, standing in line, once again, crying and boo-hooing about how they can't get their offer accepted. I'm like, yo, you need to get your offer accepted now, why these home prices are low and why you can, or excuse me, low is relative. You know what I mean?
Right.
Lower.
Mm-hmm.
Because when we inject a whole bunch of people bidding on homes, it's going to drive the prices up because, this person is going to say, well, this $400,000 house, I'm willing to give you $430 for it. And then that's going to drive the prices back up. Like I said, you remember I said, I went from 385 to 647. That's a byproduct of people bidding the market up. You don't want to be in that situation. There's nothing like a beautiful, 4.5% interest rate on a $647,000 house. Would you rather have that? Or would you rather have a $385,000 house at 6.5?
Right. And
when the rates come down in July, now you take that 385 and you refinance with Anthony again, for something in the fours.
Right. And then Anthony teaches you how to flip that equity that you got in that home, right?
Absolutely. Absolutely. So we're encouraging everybody, who's interested in purchasing now to do it now. If you have aspirations, to buy this year, I tell my folks it's never too early to get your credit pulled. Once again, one of the misconceptions in the Black community is don't get your credit pulled. Don't get your credit pulled. I'm like, y'all are driving me crazy with this foolishness. It's like in the, I'm like on a total poll. Don't get your credit pulled is down here.
Right.
That's very true. And I'm gonna be honest. I'm like, I joined these little Facebook groups and I'm on this Facebook group about, credit cards and getting the most out of your points and money. And, so you can use it for vacation lifestyles. And this guy was like, somebody made mention and was like, well, my credit got pulled for this. And it was a guy, don't look like none of us. He said, if you're worried about credit, you're in the wrong group because we're here to hack and flip and make our money work for us. And I said,
yep.
There we go.
For anything I ever wanted or tried to do, I've never been scared to get my credit pulled. I don't care.
Right.
I'm going to see if I can get it.
Yeah.
Because your credit's going to fluctuate no matter what you do. You can use your credit card to buy groceries next week. If your debt to income, it fluctuates. Right. So if the credit amount goes up and your limit goes lower because you're using more on the card, that your credit score is going to change no matter what. It changes all the time.
All the time. It's a living, breathing thing.
Yeah, I'm not scared.
Yeah, the credit report, like when people say I pulled my credit and my score was this, I was like, yeah, that's when you pulled your credit. I'm pulling your credit today. I don't know how many of your creditors have reported in the time span that you have looked. I don't care about your little credit thingamajig with your bank on your cell phone, because guess what? We're not using the same algorithms. You have Experian, TransUnion, and Equifax. I'm pulling all three. And
I was going to ask you about that to kind of explain, what FICO is, because a lot of people, they're like, well, Credit Karma told me this. And I'm like,
Hey, wait a minute. Hold up now. I got Credit Karma.
It's not real.
Don't come to me talking about what your Credit Karma score is, brother, because it's going to be 40 points lower when I pull it.
Yeah, I don't care about those Credit Karma.
I know you saw that meme. I know you saw that meme going around where it was the guy who was like, Credit Karma told me my credit score was 780. When I went to go get a car, it said it was 540.
Yep. all day. I mean, that's the worst thing. We in the car business way back in the day, we would call it like peel them off the ceiling. I mean, like when you just like, yes, I got this going on, and then it's like, sorry, sir, I got a bushy bub. I'm so sorry, Mr. Jones, but you really do have a 600.
Mm-hmm.
Yeah, that Vantage credit score is a beast. In the mortgage industry, we don't use it. Equifax, TransUnion, Experian, we use FICOs. So at the end of the day, we're gonna use all three. We're gonna pick the one in the middle. We call it the middle credit score. When it comes to mortgage lending, if you have you and a second borrower, whether it be a spouse or your auntie or whoever it is, we're most times going to use the lower of the two middle scores. People ask me, the why. I think it really has more so to do with the weakest link in the transaction. I mean, if one of y'all, God forbid anything happens, I mean, we need to, everything in the mortgage industry is risk based. So they're going to base, the interest rates and everything on the weakest link in that transaction. There's only one lender, and because this conversation is North Carolina based, I can talk about State Employees Credit Union. North Carolina State Employees Credit Union, to be more specific, is the second largest, at least last time I looked, the second largest credit union in the United States, I think behind Navy Federal.
Mm-hmm.
You notice there's one on every other corner. But they are, they don't follow regular, like what we call Fannie Mae, Freddie Mac, regular standard mortgage lending guidelines. They created their own particular set of guidelines. They follow their own rules. So a lot of times, if something really is quirky with a client, of course, I don't like giving up any business, but they have some stuff that they can actually get away with just because they don't follow normal regular guidance on.
They originate and they service their own loans, right?
Yeah, their loans are not sellable across the market to anybody. They have to keep that, we call it paper. They have to keep that paper in-house. Nobody wants it. Nobody's going to buy it. There is no such thing as a 100% 5-year adjustable rate mortgage anywhere else but there. You keep that.
Yeah.
You keep that. You hold on to that yourself. And then on top of that, from what I understand, I don't know if they have finally moved in the direction, but everybody else does risk-based pricing. So, if Renee's credit score is a 700 and Leon's credit score is a 650, they both have the same income. They both are buying the same exact home. Renee's interest rate is going to be slightly better. Renee's what we call private mortgage insurance is going to be lower, but she has a better credit score. We can talk about that if y'all want to talk about PMI later.
Yeah, let's go, because I think that's another hindrance from people kind of making that jump into home ownership.
So, what is the prime? What is the range of the credit score? What is the best credit score?
What's the worst I've ever seen?
I was going to ask you, what's the worst you've ever seen, and how did you help them overcome that to be able to get a home?
Yeah, the best credit score to get a home. Put it that way. Put you in a
So
position.
worst and best.
That question is all right. So once I break it down, then you'll see why I answer how I answer. So remember, I said everything is risk based, right?
Yeah.
So back in the day, I used to do FHA loans for people who had credit scores in the mid 400s. 100% financing. It had down payment assistance attached to it, and the interest rate was stellar. Meanwhile, over here across the pond, that same borrower couldn't even get a loan because they were talking to people who didn't do FHA loans. They were talking to folks who only did conventional loans as well as subprime loans. And so subprime lenders didn't really want to do too much with credit scores in the fours. So the worst credit score I think I seen was in the high threes. Yeah, it was amazing. It was amazing. I wanted to save that thing. I really feel like I should have put it in a frame and just kind of redacted the name. Like, dang on, woo!
I mean, were they like new to the credit, or things happen, right? Divorce, marriage. A lot of those things can affect your credit, right? Everything. How were you able to kind of help them, or were you able to kind of help them get?
Yeah. So it really, honestly, Renee, you can only do but so much.
Yeah.
If based on what that person, their drive, their motivation, right? So to have a 300, something in the 300s, you really have to go either have hit like super rock bottom, which is a real thing. Like people have, I just got finished telling somebody on Facebook, like, don't be quick to judge. It was a video where a Mercedes-Benz was getting repoed and the person was trying to drive off, while the truck is pulling the car off. And I said, albeit that's not right. That's not smart, rather, for them to be trying to drive off. Because at that point, you're not the car's owner. The bank owns the car until you get the title, like the bank owns the car. So once they hook that car up, now you on some Grand Theft Auto type stuff. Okay. Right. But I tell people all the time, it's like life really happens. So, for me, like 2023 was a rough year in the mortgage industry. Like I did a flip. I lost 6 figures on a flip.
Do you wish you would have kept it a little bit longer? Do you wish you would have kept it a little bit longer, or do you wish you would have kind of sped up the process?
Yeah. I wish I would not have put as many upgrades. This lady has 3 freaking bathrooms with garden tubs in them. Not garden, but I'm talking about not garden, the soaker tubs.
I know.
I mean, we couldn't predict the market. So I over improved this property. And when I drive past it every day, I'm like, I cuss every time I pass this house. I'm like, that 100-foot driveway. She got a pad to put her trash.
The pictures.
She won. She won. And so when you buy, I bought a house that was basically 100 years old. So when you walk in these old houses, I mean, the floor is going like this. Like I left no stone unturned. Like you walk in that thing is so flat. It's like being on a slab foundation. Like you don't hear a creak, a moan, nothing. Right. I took a 4th bedroom that did not have an access door to it. Like this is one of those old houses where you could literally walk through all 4 bedrooms like you were Casper the Ghost. Like it had a doorway cut out so you could walk through all 4. There was going to be no procreation going on in this house. I don't know how these people did or lived like this, but I had to seal up all those openings. And the 4th bedroom, which you could not access, I just turned it into a full-blown master's bathroom, and that thing was gorgeous.
So did you? I hear a lot of people say when you flip a house, don't add too much to it. Did you add too much? Do too much to it?
I put too much heat on that one, and so with all of that, we just didn't sell it in time. Like the market just tanked, and I was caught out there with my pants around my ankles. I was like, dang, like wow, and I lost a nice chunk. So you remember when I said my house went from 385 to 647? I bought that house for 325, and the comparables, I was going to say comp, which is an industry term. The comparables, which means the homes that had the similar size, number of bedrooms. They were selling around 680. And when that market tanked, that joker sold for 424. And I'm telling you, my polo feelings. I mean, like, so you're talking about a slowdown in the market and then losing a nice 250 to 300 grand on a flip. Like, now I don't know many people who can rebound from that stuff. So I'm like, thank you all for choosing me as your favorite mortgage loan officer to help me rebound from this woe.
Yeah.
Yeah, that was a painful one. So the lesson that I learned, moving forward is, when you get into investing, fix and flips, things of that nature, just stay in your lane. Don't over improve. Don't act like it's your house. Like flooring, carpet, hardware, paint. If it needs a new roof, new roof, and keep it trucking. On to the next project.
Right. Do all the update HUD requires of you, so you can get some of those people too, right?
Yep. So we some of the best lessons are some of the more costly ones. So learn from me. Don't do it. Buy something. We just slap some lipstick on the pig and keep it moving on to the next project.
Do you find it kind of hard getting people to, take out home equity lines of credit to be able to purchase another home? Do you sense a lot of scarcity in people to want to take that jump or that risk at all?
It depends on how what the pain level is. So you don't necessarily. So home equity line of credit doesn't necessarily need to always be for investing in real estate. It could be literally to navigate through life. I mean, I have teachers here in Durham who bought homes back in 2010 to 2012. They paid $100 grand for these townhomes. These same townhomes and single family residences. Actually, I'm thinking about two people right now who have single family residences that they paid 99, to 105 back then. And these same houses are worth 350 to 400 grand. So now you're talking.
I'm gonna have to raise my hand on that.
It's harder to do now, though, right? As far as the prices being where they're at.
So I mean, you got to think about it. It's all relative. So the same people who are buying for 350 right now, just like the example that I gave you for myself. I mean, like if I go on Zillow right now, my house is probably for 586 or somewhere in there, 590, something like that. So in that same short time period, I mean, the market dictates, as long as people are still moving here and driving up prices, even though you're buying a home for 450, that same 450 today, like think about this, Renee, right across the street. Not trying to tell your address, but along your street, there was some building going on that started out at 239 in the same building project, the same neighborhood. They replicated this same house over and over again. It started out at 239 at the beginning of phase 1, and they ended up in the 3s after they got to phase 3 or the last phase. And so just by being the first person in there, listening to all that music at 7 o'clock in the morning and nails clamoring and cervezas everywhere, you got in cheap.
Yeah.
you got in real cheap.
I'm trying to tell you. No, so Leon, again, he used to be one of my neighbors. See
right.
How everything is matching up?
Yeah, I see.
Yep.
He is right. I bought my house here in 2010.
Yep. And like the prices, it is what it is, right? But check this out. Now listen to this. Those same homes are now in the 3s, probably close to the 4s. So when you look at that, let's say that Renee bought her home for 99 grand and she has been paying that balance down and never refinanced, like never touched that loan. Renee should be 40 grand, 30 grand house. It's low. It's low. So they have all of this. You have $300,000 worth of equity. So think about all these teachers in Durham public schools, Wake County schools, who bought these homes that were affordable back then. They can literally tap into that equity to pay off all their credit card debt. their personal loans, their car notes, just to get out from under all of that pressure
Yeah.
of those monthly obligations. And when you take, all of these big high interest rate debts and you spread them across, this longer debt, and most times home equity lines of credit, you can get an interest only option. You're going to have a super low payment. So you can end up, somebody who has a $700 car payment and, $1,000 worth of other bills. Now you're saving them, $1,200 a month.
Mm-hmm.
By consolidating all that debt and spreading it out over, God knows how long. So what ends up happening, I coach my folks to, don't get complacent with paying that interest only payment. Like, use that newfound income that is now back in your household to, number one, pay down your primary loan. Because if you're saving, $1,500 or $1,000 a month, take $500 of that money and put it on your primary mortgage. Now you can pay that thing down. And then of course you can use the other savings to do whatever it is you want to do. Pay your home equity line of credit down, whatever. I mean, but when you go from 26% interest credit cards, to a 9%, home equity line of credit, you're going to save a lot of money. Mm-hmm. So
now let me
you can
ask
use it.
this. Is it, speaking of refinancing, in which I'm sure a lot of people did in 2020, 2021, and got stuck
with these low rates. You got stuck with the low rates.
I did a 15 though.
Yeah, you got a beautiful rate
and paid additional towards principal. So I'm
yep. Interest rate probably 1.5.
So is it good to refinance and lower your maturity date? I would say, go from a 30 to a 22 or to a 15. Do you suggest that, or do you because I know sometimes people say stay with the 30 as a buffer. If you can afford to pay more, then go ahead and do that. But I guess I hear different reasons.
Are you talking about with the day interest rate or anything?
Well, with the interest rate or just refinancing altogether your house. Some people finance with a lower term or a shorter term, excuse me.
So once again, this goes back to listening to your client, right? Mm-hmm. So if you tell me, hey, look, I'm about to get out of here in the next 5 years, then I'm going to ask you why. Why would you take a shorter term? I mean, because in that time frame, in 5 years, your home is going to be, and I'm not saying that this is the end all be all,
right?
One size fits all advice. Everybody's situation is going to be different. But if you're telling me, hey, Ant, I'm going to be out of here in 5 years, well, I'm thinking about, the appreciation and values that's going on in the triangle or wherever you're at. Like, historically, it used to be in North Carolina, 2 to 4%, per year was like an average thing. In the triangle, nah. Like, these people are moving here and driving up, the price of homes. So you're seeing like humongous jumps in appreciation. So I'm not so keen on telling folks, yeah, man, the goal is to pay your balance down because your home is probably appreciating just about as fast.
Right.
Also, I would never encourage somebody who's self-employed, to go from a 30-year down to a 15, because guess what? If you get a 15-year note, that's what you're responsible for.
Mm-hmm.
That's what you're responsible for. You're on the hook for the 15-year note. And that payment's going to be much higher than what it would be on a 30-year. When in fact, what I can do is I can show you like, hey, if you're trying to pay this home off in 15 years, here's the actual payment that you would need to pay in order to achieve that goal. So instead of paying $1,000 a month on a 30-year, you're going to pay $1,700 or whatever the number looks like. Mm-hmm. And I coach you to do something, take that strategy and make sure that they take the extra $700 and put it towards principal only. Make sure that you're not dealing with, we service our mortgages. So, we're not like some of these unscrupulous lenders out here where you got to tell them 2 and 3 times. You're wondering if they're going to apply it to principal or put it in your escrow, or put it over here somewhere, or doing something funky and slick with it. So you got to be very careful to let them know, like, this needs to be applied to my principal only.
Yeah.
That extra payment.
Put it somewhere else. Right.
Yeah, they'll try to shove it somewhere else.
Yeah.
So if that's the goal, for my self-employed people, I definitely coach them to do that, because, with us, I'm 100% commission. So if I don't close a loan, like, I'm not getting paid. And I've been like that for the last 25 years. So I have to earn every referral that comes across my desk. And so with that, I would never put myself into a situation where I'm putting myself in harm's way. On this home, myself, I'm telling my own personal business, but I couldn't resist getting this 10-year adjustable rate mortgage, because the rate was just like, oof. I was like, I love it. And in my mind, I'm like, pay the house off in 10 years. Like, I'm commission based. So when times are, robust, I make bigger payments. When times are lean, I just make the regular standard payment and keep it moving. And that's how you handle that. What you got on your mind, Leon?
So the advice you give people as far as I come back to that. How long have y'all been doing the 15,000 towards homes?
Oh Lord, I don't remember what year that came out. It's been a while. It's been years. It's been going on for a few years. Leon, I can't even tell you how many years. It's definitely been 5 years or more that I recognize, because I didn't start doing North Carolina housing down payment assistance until I got to New American Fund. Oh no, yeah, when I got to New American Funding, so 2017, somewhere up in there.
Oh, okay. I'm gonna say they didn't have that when I was buying my house.
So they had a stint where I think they were doing like $7,000 or $8,000 back then, and then it went up to like 15 grand. We were like, yes, hallelujah, let's go.
No, it was more of, it was telling people, go to NACA. I'm like, no.
Yes, Lord Jesus have mercy. Y'all want to talk about that one?
But we're not gonna, that's the conversation for a whole new day, because we can get on that.
Is it? Because I mean, I'm definitely here to dispel myths.
Go ahead and educate the people on it, because what I do, I can't go into that. But
all right. So I can. So
yeah, tell us.
NACA in and of itself, like, the actual loan that is attached to the program is out friggin' standing. If you gave me that loan product and let me close that loan product, let me tell you something. I take over the world with that loan product. 100% financing, no PMI, and a below market interest rate. Like, that is the sweetest mortgage loan product in existence. The problem is the execution, the process to get to the money. It's cumbersome, and I'm using that word lightly. For the folks who have tried it, there's a lot of agents who will tell you, in the background, like, look, if I see a pre-approval letter with any hint of that, is getting tossed into the trash can, because it's not about the product, it's about the execution and getting you as a client to the closing table. And they're not very good at executing and getting folks to the closing table in a timely manner. Now, I'm purely from the outside. Just don't take this as the gospel. I'm just speaking purely as an observer, way from the outside. And I do know a real estate agent that I work with on a daily basis who used to work for NACA, and she loves the product in and of itself. But of course, she also recognizes the flaws that come with it. But me personally, I think that if they had two different tracks, people who have great credit and have shown financial know-how, literacy, they understand how finances work, You can pull their credit report. You see their income, their debt to income ratio. Like they know how to pay bills. They have no issues whatsoever. They need to be on track A. Boom. You go straight to the head of the line. Bye. Track B is everybody else who literally, or let's just say, let track B be the folks who, hey man, back in the day, I experienced a little bump, a little bruise. I went through a period where we got laid off. There were some layoffs. It caused me to fall, behind. You can see that it's a very tiny window in between, employment, blah, blah, blah. I was able to bounce back. That should be track B. Track C is, man, listen, I ain't paid anybody on time. I didn't even know once you went past 30 days that was considered a late. I've never really paid attention to my credit. Don't know how credit really works, blah, blah, blah. That's track C, right? You can't mix all these people together because they're on 3 different tracks. And I think that because they're mixing all 3 groups, and they're probably more than 3 groups, but I'm trying to simplify it, that it causes the funnel to get clogged up. And if they could fix that problem, man, listen, that they could close so many more loans than they're closing. The reputation will be cleaned up immediately, and everybody would probably use them. Seriously, because the loan product in and of itself is bar none beats State Employees Credit Union. Because it's on a fixed rate. It's on a 30-year. State Employees Credit Union, y'all, is on a 5-year adjustable rate. So that means that after 5 years, that thing can go up. It can go down too, based on the market. But you better have an exit strategy if you have a 100% financing loan with State Employees Credit Union.
So in different situations, is it? I guess you adjustable and fixed.
Yep. I don't put my first time home buyers in anything adjustable. Like you got to tell me, look, I'm gonna move up. Jumbo clients usually get adjustable rate mortgages, things of that nature. The crazy thing is adjustable rates are so close to fixed rates that I haven't had anybody even take an adjustable rate here in the last 4 or 5 years.
Oh, wow.
Yeah. The fixed rate money has been cheap enough for everybody to say, you know what, I'll take the stability. And if I find something, cheaper during a refi, I'll take advantage of the refi when we get to that, because they don't want to wear it. They don't want to worry about it. Back in 2008, when everybody foreclosed, that's a byproduct. That's a byproduct of people being put in very bad loans prior. You imagine. I remember this husband and wife team here, y'all, in Durham. I feel like they were like the slummy, mortgage loan officer team. They were doing loans for like Beezer, and they were getting these loans done. They were getting them done, right? Mm-hmm. And imagine, this is when we talk about how whole entire neighborhoods foreclosed immediately. Think about how our friends think, right? Imagine if Susie buys a house and she got a 500 credit score. And that goes back to Leon asked me a question, what's the lowest credit score? I do loans as low as 500 on an FHA loan. If you have 10% down, it's kind of still hard to get them approved because the computer doesn't really like, very, very bad credit. At 500, that means you probably have very recent lates. So the more you put down, that does what? It reduces the risk. So the computer understands like, okay, now we got 20% down. I might like it a lot more. So on an FHA loan, 500 is the low that I go. And then with 10% down or more. And then if you only want to put down 3.5%, 580 is the lowest score. That's an FHA guideline. So now that's if you come to me, you go to somebody else, like let's say Truist or Bank of America, they're going to do what's called putting an overlay, which is just added guidelines for just them. So FHA says 580. They, as a banking institution, might say, but our overlay is a 620 or our overlay is a 640 on an FHA loan. So, So you got to be very careful. I'm glad y'all are doing this here, because people think that FHA is FHA everywhere. It's not. You have people that
I didn't know that.
Yeah. these other lenders and banks. So we lend to what's called agency guidelines. So we don't add any extra funk to it. We're going to follow the rules. Here it is. These are the conditions in which FHA or VA will back this loan. So have y'all ever heard of debt to income ratio?
Yes.
Yeah.
Okay. So if you go to a bank, like some of my competitors on a VA loan, they will say, hey man, the maximum debt to income ratio for our VA loan is 50%. That basically means, for everybody out here who doesn't know what debt to income ratio is, 50% of your gross income can go towards your mortgage and all your bills. That's it. Cut and dry. You make $4,000. You only got $2,000 to work with. I got to fit your mortgage and all your cars and your credit cards and everything got to fit within the $2,000. That's it. That's all it means, right? So with most banks, they'll say, 50% debt to income ratio is our maximum on a VA. The VA does not have a maximum debt to income ratio. They do not have one. So, if I can get somebody done at a 60 or 62 and the computer approves it, I'm going to close it. Do I like doing that? Nah. Yeah. If I know that there's a significant other in the household, y'all are just not married yet, I know you got some more income in the house, I'm cool with it. You got your fiance, you got to be married on a VA loan. You got your fiance in there as 2-person income, but it's only the husband who's the vet, or it's the wife that's the vet. We're going to do this 100% financing with this higher debt to income ratio. We're going to close and you're going to get this great interest rate and go move on. So that's the credit score piece. Now back to the neighborhoods and the foreclosing. Imagine all of these loan officers. If Leon comes home and he says, man, I just signed on a dotted line for I'm not picking on Beezer. I'm just using them as an example. Beezer, and $175,000 house. This was like a real scenario. $175,000 house. Man, Leon, man, you got a 500 credit score. I know. You really got a house? You really? Word? Okay. I'm going to. Now Renee goes up there and she got a 520 and she get approved for a $175,000 house. What's going to happen, y'all? Everybody named Mama is going to get a house in Beezer, right?
Mm-hmm.
That's just how we do. And so what was going on is they were getting put on 2-year and 3-year adjustable rate mortgages.
Ooh.
So imagine being put in a mortgage that is 9%, and then after 2 years, it skyrockets up to 12 or 13%. And then imagine being in a 10% and it goes to 14% in 3 years. So what ended up happening is Leon payment goes from 500 to 900 overnight. Leon's like, oh crap, I can't afford this anymore. Leon doesn't pay his bill. Renee, think about neighborhoods, y'all. In new construction, everybody does what? They buy and close pretty much in the same time frame.
Yep.
Right? Within a year and a half, everybody's closing out. So imagine the neighborhood is full of Leons and Renees who are on, adjustable rate mortgages. Guess what? We all foreclosing all at the same time. Everybody going away from here. And the only people that survived that melee were the people who came to lenders like me who were doing FHA loans. You had your 474 credit score, but you got that good interest rate at 7% instead of 9%, and you're on a 30-year fixed. Now, the problem is your $175,000 house is now worth $85 because all your neighbors are foreclosed.
Right.
And all the investors.
Everything go down.
Yeah, everybody. But the thing about it, Renee and Leon, is this right here. The neighbors couldn't even refinance their homes and get out of the 2 and 3 year notes because everybody's house is underwater because all the other Leons have already foreclosed. So when we do appraisals on homes, we look at what are called comps. Stands for comparables. We look at comparables. And the comparables are the most recent sales of homes that are similar to yours. So if the last 3 sales have been to Joe Schmo over here at 85 grand, your $175,000 house is now worth 85.
Right.
And so you can't even refinance your loan, even if you started out with a 500, you improved your credit score to a 650. You can't even get out of it because your house is only worth 85 now. You're underwater. So now what happens? You foreclose too.
Or give it back.
Yeah. You didn't lose, but you still, hey, look, credit still toe up.
Yeah. Yep. While we're touching on this, because we talked, about home ownership, interest rates, and all of those things. Can you touch on escrow? Because I find that very difficult for people to really understand, and they may not have, branch managers such as Anthony who can explain all the ins and outs. But I think people have a hard time really understanding
what escrow is.
Yes, and they don't understand it.
I'm gonna break it down for you in the most simplest way that every American understands. Uncle Sam, when he takes taxes out of your paycheck, every pay period, that's escrow. You're getting money taken out of your paycheck so that at the end of the year, your tax bill is paid. Because if you left it up to us, if Uncle Sam didn't take that third of your check or 25% of your check, and they said, Anthony, at the end of the year, I want you to pay me my 25%. Bro, you ain't getting paid.
Right.
I don't blew that check. It's gone. So escrow is exactly that. Escrow is, let's say you have a mortgage payment of $1,000. Out of the $1,000, you have what's called principal and interest. That's the actual loan itself. And then you have what's called taxes. And then you have insurance. So we all know what taxes are. The insurance, Allstate, Geico. Renee, you back? Allstate, Geico, all the commercials that you see on television. Those people will do an insurance policy on your home to cover pretty much the majority of everything, natural stuff. And so anyway, escrow is us saying, all right, we're collecting $1,000 a month, which let's say $700 of it is your principal and interest. The other $300 is your taxes and insurance. And then some people have PMI or what's called mortgage insurance. And so at the end of the year, when it's time to pay your taxes, you're not scrambling around digging in your pockets, looking for the money to pay the tax man to cover your taxes on your property. We've already done it for you. We've already done it. So 200 out of that 1,000 is put in an account over here month by month. So when that tax bill comes due, you're going to get a copy in the mail. You don't need to do anything with it. The mortgage company is going to pay it on your behalf. Already paid. Yep. And then same thing with Allstate, State Farm, Geico, whoever you have your homeowner insurance with, same thing. You're going to get, a piece in the mail, that says, hey, your insurance policy or whatever. But it's already covered. The mortgage company is cutting them a check for that amount that you owe so that you don't have to worry about it. And so the reason why they do that is because nobody wants the tax man to foreclose on you, because a tax foreclosure can definitely come before a mortgage foreclosure. We don't want to have a house foreclosed over $5,000, $10,000 worth of taxes because you owe me $350.
Yes.
And we get
now, explain how that will can also change your payment down the line throughout the years, because some people feel like my person told me it's going to be $1,000, and I don't understand why my mortgage payment has increased to $750. Yep,
it's called the tax man. Tax man is relentless. Tax man is gonna reassess your home's value. You can pretty much, what most people don't know is you can dispute pretty much anything down at the tax office. Like if you can show them, I don't know how you're gonna show them that your house in Wake County or Durham County or surrounding areas is worth less, because basically what happens is you have the market value of your home, and then you have the tax value. The tax value, my 25 years, I've never seen a tax value higher than the market value. Tax value has always been assessed lower than a market value. And I'm glad that that is the case. We definitely don't want to be paying taxes on the market value of our homes. But if you feel like, like your vehicle, you tired of paying, these hefty taxes on it, you can dispute that. I wouldn't walk into the tax assessor's office talking about, yeah, I think my house is worth less. They're going to really send somebody out there for you.
I learned that about a year or two ago, and I didn't know anything about disputing it. And then I think I got something in the mail. It might have been a tax paper, and actually, I think it said it on there that you can dispute it.
Yeah,
I never knew that.
Yeah. I tell people all the time. I had a sports car that I had to get rid of because I just broke it. But that thing, man, I would see that tax bill every year. I'm like, oh Jesus, like I need to fight this. I need to fight. Mm-hmm. I went to go pay taxes on that thing one year, and the lady looked at me. She looked up. She was like,
how long did you keep it?
3 years. Yeah, it was a Nissan GTR Nismo edition. So the car brand new cost $300,000. Excuse me, it cost $212, but you can't find one for $212. Nobody wants to sell them for that. So the new ones are going for like three and some change. And so they're trying to hit you over. Like my car was one of 3 in North Carolina. So anything I did, people are like, yeah, that's Ant.
That boy got his own money.
Right.
Hey, look, that boy. Hey, look, I got a ticket that I'm fighting right now. They talking about taking your boy license.
You still fighting that ticket? We talked about that.
Yes. Yeah. You going 3 figures.
Oh, goodness.
Your boy was supposed to get in them handcuffs, but yeah. So now I'm just driving the Honda Accord peacefully, like driving Miss Daisy.
Now, speaking of kind of like escrow, I get, I hear from some people who purchases new builds, right? And the community isn't 75 to 85%, sold out. So, their payments, i.e. escrow payment, looks a little bit different. How do you explain that to a customer? Because, the following year, it may increase a lot more than what it was when they originally purchased their home. How do you explain that to customers?
Yeah. So I did a loan with the credit union and had that sticker shock, because they just really did the taxes based on the land assessment at the time. Mm-hmm. And I was like, my savings grace is that I'm in the mortgage industry. I was like, well, I know these ain't the right taxes, so let me go on and get my money right, stack that off to the side, because I know it's coming. That's called an escrow shortage. When they come back to you and they hit you with that, hey, yeah, Mr. Holt, you're gonna need to pay us an extra $300, $400, $500 a month to get caught up, so that your escrow can be paid for next year. You don't want to hear that, So here at New American Funding, we try to get a much better idea between the builder, the attorney, and our closing department to prevent that. Mm-hmm. We try to make sure we're looking at Durham tax rates, 1.25%, and we're coming for you straight out the gate, because we definitely don't want you to have that sticker shock. When I do what's called a loan pre-approval, we didn't even talk about all that. When we do a pre-approval, like I literally plug in the tax rate for Wake County, the tax rate for Franklin County, the tax rate for Durham County, because most people don't know Durham County taxes are more than Wake County.
They are.
Like, oh, really? Yeah, like we getting knocked over the head here in Durham. But, so when I do my payment estimates, and this is one of the things that I want to tell, your audience, people are like, how do I decide who my lender is? And we can come back to escrow, Renee, but my brain kind of goes off into different little branches. But, we'll use like Quicken. Quicken is in Detroit. One of their call centers is in Detroit. I promise y'all, they don't know jack diddly squat about what's going on down here in North Carolina. They are putting stuff in a template, and they are hoping and praying that is correct. And when I see closing cost estimates from, these big call centers that y'all are used to seeing on television. Like, people have a tendency to go with their bank because that's who they're comfortable with, because that's what they know. And that's typically the first inkling, which is where people go wrong. So, these call centers, they don't know anything about the market. And I promise you, when a real estate agent sees a approval letter or pre-approval letter from Quicken versus Anthony, who's local, like right around the corner, they're gonna be like, I'm tossing that Quicken out, because Anthony here, I have something to lose.
Right.
And as a consumer, you don't realize this when you're shopping for a mortgage, because we're trained to shop based on rate. We're not trained to shop based on the reputation of the actual loan officer. So in saying that, even in my own company, can you find a loan officer that sucks? Absolutely. Is just terrible? Absolutely. We got 4,000 people that work here, right? I mean, like, nobody's ever going to be exactly the same. I coach my loan officers the whole 9 yards, but if you don't answer the phone like I do and respond in the same timely fashion that I do, like, some of these lenders, you ask a question at 8 a.m. and you might get something by 5 p.m. Like, that's not my service level. My team, like, we're responding within 30 minutes or less. Like, you text me, unless I'm, in a meeting or something like that, you're going to get an immediate answer. So it's small things like look and Google me. Like, you can Google Ant.Holt and the word mortgage. You're going to find 25 years worth of stuff about me. If you can't do that with your loan officer, stay away. Mm-hmm. Unless somebody has said, hey, Leon is the man, like, he took care of me. Do not go into these institutions talking about, give me a loan. Give me a loan. Because these people are not going to work on the weekends. They're not going to be available. Like, it's 9 o'clock right now. My phone's still going off. At 8:30, 9 o'clock is probably when I'm shutting it down. 9 and beyond, you got to be like my number one real estate agents, that 9 to 11 o'clock time period. Customers, come on, man, treat us like you want to be treated.
Right.
Text it and call it at 11 o'clock is unacceptable. That happens. That happens. I'm like,
crazy.
Christ. Yeah, but that's the difference. Customer service level, being available. That was my frustration when I did my first loan with State Employees Credit Union. I didn't want my information. The first time I did a mortgage, I was like, man, who has access to be looking at my credit? What I got going on in my company. I was like, I'm gonna do this first one over here. And I'm telling you, it drove me nuts because I'm so used to getting responses in real time. Like, my service level that I give to my clients, I was like, this lady ain't called me back. Like, I would literally have to get in my car, drive to the branch, sit there in that waiting room. Like, I ain't going nowhere. So I hear something. Like, what's up? Because my insurance guy emailed you 2 days ago. You still ain't responded. Like, I need my homeowner insurance policy in effect. Like, we closing in 2 days. What's up?
Right.
So didn't do that anymore. But yeah, so what other topics did y'all have in mind, Renee? Because I mean, I'm trying to think. The first time home buyers, they deal with credit, they deal with savings. Don't blow your tax money. If you're trying to buy, save your tax money. Let's put that where it needs to go, because you're gonna need it for, if nothing else, a deposit to let the seller know that you're serious about buying their home. Regardless of whether I have $15,000, you're gonna need to pay for an appraisal. You're going to have to pay for inspections. You're going to have to pay a deposit to let the seller know that you're serious about buying their home and take it off the market for you. So even if you just have $2,000, that $2,000 is spoken for. Easy, quick, fast, and in a hurry.
I like that. I have a question. And then, Leon, you can ask your question after this, and then we'll let Anthony go and handle his, as he's standing in business. I want to know, it's this big thing on social media, renting versus buying. What are the benefits?
Of buying
versus renting?
When you're renting, you're paying 100% interest. That's a fact. You paying somebody else. So, you paying 100% interest. You're not building any equity. Can't do what you want. The first time I literally walked in my house and I said, man, I actually got a garage door opener. I got 2 of them. Got 2 of them. Do you understand that means that I ain't got to warm up my car no more?
Mm-hmm.
Ain't scrape off no snow? What? What? You know, I got my kid on my wall. I can paint my walls black. Hey, look, I don't know if you can see the ceilings.
Love that.
I can
That
do.
boy
I can
got
do
his
what I
own
want. That boy got it on money. Hey, look, he up there tearing up stuff and doing what he want. You know, I couldn't do that when I was renting. Also, this is something that personally would tick me off. So Renee says, hey, you know, like the tax bill, your payment can change over the years because your taxes go up. So when your taxes on your home are reassessed, your actual full payment could go up or increase over time because of the taxes going up. But it's not due to the mortgage itself. It's the taxes or the homeowner insurance going up. You know, homeowner insurance companies are doing folks in, especially on the coast and down in Florida and things of that nature. They're just kind of going crazy. But if you've ever rented, at what point in your life has your rental office called you and said, hey, Renee, hey, Leon, you've been paying on time all these years. I'm going to lower your payment for being on time all these years. They have never rewarded you for making on-time payments. Now, what I will tell you is this: the ultimate slap in the face is when you find out that they're running a special on your apartment and somebody who's walking straight off the street is going to be paying less than what you're paying. And you've been there paying for 4 years like clockwork. That's the ultimate slap in the face. If you want to ever get motivated to buy a home, call your same apartment complex and act like you a new person wanting to rent the same apartment that you in right now and watch them give a rate, an entry level rate or some kind of special. And you're going to sit there and it's going to drive you up the wall. I'll be expecting your app at Ant.Holt.com. It's my name right there. You see my name on the screen. Just push them together and put .com at the end. That's my website.
Some people like renting because they feel like they don't want all the responsibility of fixing stuff in the home, and cutting grass, or sometimes you do rent, you got to cut grass depending on where you're renting from.
Yeah. So we have townhomes in my neighborhood. You got townhomes around the corner. It's called HOA, homeowner association dues. You're gonna pay that. Somebody else is gonna power wash your house, mow your grass. All you got to do is push your little trash can out to the front.
Let them know. Let them know. I'm the president, so you know.
Yeah, exactly. I happen to like mowing grass. My yard is the size of my living room. All I got to do is go up and down twice. And my neighbor got the other up and down twice, and the grass in between our houses is taken care of. So I'm good. But I love it. It's a sense of community. Where I live, I have 2 fraternity brothers that basically live on my street. My boy Dayton lives directly across from me. He borrowed my little weed removal tool. My boy Isaiah lives right across the street from me. My boy Brent lives 3 doors down. The assistant chief of police for Durham used to live next to me until he moved. So it's a sense of community. Even when I lived with Renee, I knew 4 or 5 people around there. And so when people walk around my block and they look like they don't halfway don't want to speak, I'm like, hey, how you doing? You must not live on this street. I'm gonna make you speak to me. You come through here, you go speak. We got our own culture on this street. So but it's all about community. And when you finally move to a neighborhood, you can actually change or set the culture of your neighborhood.
Yes.
Like you can actually, people don't realize that, your community, moving somewhere and just developing relationships with people. With homeowners, there's a sense of pride in homeownership. And so in with that sense of pride and homeownership, a lot of times you develop community where sometimes it's a positive vibe. In certain places, you develop a culture where people just don't speak, which is unfortunate. But you know, that's part of learning where you're moving, doing a little research. It's a little bit beyond, well, what school is in the area. You want to look at the flags that are hanging outside people's front doors. Real estate agents can't really go into too much in-depth stuff like that with you, but drive through there at night, see if people are walking around, at 9 o'clock at night, through the neighborhood. That'll let you know if it's comfortable out there. See how many cars are parked, out in the street at 9 o'clock.
Yeah, that's important.
Yeah. I mean, if you see people with jack stands and, look like you got car lot going on over here, you might not want to live there, but that's all about research. Do you want a house that has a HOA versus not? I got a fraternity brother of mine. We used to go to his pool parties. They were epic. And I would just laugh driving through his neighborhood because one year we drove through there and this lady had corn. Literally, this is a residential neighborhood. This lady has corn growing in her front yard. Stalks, like boom. I'm like, I said, dog, do you have HOA? He was like, minimally. They don't enforce nothing around here. I was like, oh, so you can paint your house purple and gold if you want to. He's like, basically. I was like, oh yeah, nah, I'm good on that.
My neighbors don't get no ideas.
Nah.
My neighbors definitely won't do that.
Yeah, man. So you got to think about, those are things that you take into consideration when you're buying. Do you want to be in a more rural area? I got an aunt who wants to move here from New York, and I'm like, yeah, come on to Durham. She was like, absolutely not. We're going to Rocky Mount. I was like, Rocky Mount? Like, how do you even know about Rocky Mount? But that's what happens. People get exposed to.
A lot of people going to Rocky Mount, them areas right there because of the pricing, right? Pricing on the houses.
She's gonna buy something big for $200,000.
Yeah,
$250,000.
Yeah, places like that.
Yep.
Mm-hmm. Speaking of the whole buying a house versus renting, you have me thinking, because I never thought about that. Well, it's like you live in an apartment, right, or a home. You renting it for 5 years. You miss that one payment. See how loyal they are. See if they remember them 5 years that you paid straight. Right? They're gonna kick you out by the 5th. If you haven't paid the 5th or the 6th. With the mortgage, you got a little bit more wiggle room because there are laws in place that protects you and want to help you stay in your home. So it prevents, all of your whole neighborhood going into foreclosure, prevents, your home from decreasing in value. So that speaks volume as far as, renting versus, owning your home. I mean, really, there's not a lot of loyalty in it. At least the bank will say, well, this person has made payments straight and hasn't been, late for 3 years. So we got to help them out.
Yeah, they do. So I worked briefly for 6 months. I got out of what's called mortgage originations, which is what I've done historically, to do loan modifications. When the market tanked, we all wanted to stay in the industry, but the mortgage industry just came to a screeching halt. So we all had to kind of get in where we fit in. But I remember one time, my first day working at Wells Fargo in the loss mitigation department, and I was reading this screen, and my manager was telling me, like, okay, so this is the delinquency. And I was like, oh, 55 days, that ain't bad. He was like, nah, bro, that's 55 months. I said, hold on.
Mm-hmm.
Hold on. They ain't made a payment in 55 months and they still in the house? He was like, yeah. I was like, what? I was like, what? Like, you ain't, huh?
Any places like Chicago? Ain't Chicago one of them cities?
Yeah, I would say most pertinent in New York and Florida.
Okay.
I've seen some crap. Did y'all ever hear that story? There was a lady who her landlord had went to prison for like 10 years, and she was living in this house. I don't know if it was in Detroit or some other city. Are y'all still there?
Yeah.
Okay, y'all screen is frozen on my side.
Yeah.
Am I frozen on y'all side?
You keep going in and out.
Yeah, but you good now.
Okay. All right. So the house, the city was like, after 10 years of her basically squatting there, they said, we'll sell it to you for $7,500. And this lady could not come up with that money.
And hadn't paid in 10 years.
Hadn't paid in 10 years.
Gotta be Detroit. No shade to Detroit, but I could just picture that more there. I'm gonna be really honest. I can picture that there.
Yep. Yeah, that was real. I was like, wow, that's nuts.
I got one last question.
Okay.
In this climate, for somebody making anywhere between, I say, 40 to 80,000, just a single person.
Yep.
Do you think it's affordable for them to buy a home?
So is a $40,000 person single?
Yeah, say they single or
Oh no, where'd he go?
tapped out.
Wait a moment, people. We have any questions, boy?
No, we answered the questions we had in the beginning.
Okay. See if he'll log back on.
What do you think about that question?
I would say 40,000. That's tight, but I look at it two ways, right? So
Let's say 80,000. Then
I'm gonna go with the 40,000. Are they living on their own right now?
Right. I don't know. It was just, I heard
I'm just thinking these are the questions that I would ask. Like, are you living on your own right now? How much are you paying? Right. So if I were ever, a loan officer or whatever, these are some of the questions I would ask. How much are you paying? How much are your monthly expenses? Right. Because you can be 40,000 pay. I think I made out. Let me think about one point when I was, within that bracket. I think I had rent of, he's back. Perfect. I was trying to answer his question of the 40.
Internet.
What'd you say?
Yeah, Frontier
Internet.
We got to move you over to. We got to get you over to Google.
Hey, look, we just got Spectrum through here a couple of seconds ago, and y'all are still frozen. So that lets me know that it's probably going to happen again. I hate it. So what was the question? You said 40. All right. So look, you said 40.
He went with the 40,000. I switched it to 80,000, but.
Oh yeah, 80 grand all day. You can buy all day long here.
What about 40,000? What are some of the things you would, ask them if they came to you and they said they were ready?
I would say, if we're talking about affordability issues and they have debts, we need to probably be looking outside of the Raleigh-Durham area, maybe like Mebane, Hillsborough, Roxborough, some of the outlying places, Oxford, Henderson. Well, Henderson has its rep. That's my second hometown. But some of the outlying areas, Butner, Creedmoor, where the affordability is there. And yes, or you can look at manufactured, like Clayton Homes. They're making very, very, good quality manufactured homes now. They're not like they used to be. That's something that can provide home ownership and affordability as well.
Yeah.
I just feel like if you make 40,000, you know how to budget your money, especially if you're already renting a place and paying rent. You know what you can afford,
right.
And you know how much money you're bringing in, if that makes sense.
Yep. It's the same way. It's the same way with anybody. I mean, so the reality is this right here. There's a lot of times there is really no difference between the person that's making 40 and the person that's making 80, because people who make 80 do what people who make 80 do. They blow the bag. Yeah. They say, what's that old saying? Poor people buy stuff, middle class people buy liabilities, and wealthy people buy assets. Right. So, I mean, I see it live. Like when I read these credit reports, I'm like, Jesus Christ, if we could just get to each other when, if you're on a college campus, get to them before Discover Card gets to them and before they start blowing, refund checks. Like if you can imagine $5,000 or $10,000 every semester, these kids could be millionaires
Right.
by the time they're in their mid-20s, if you got them in the right direction.
Mm-hmm. I asked that question because I watch a lot of podcasts, and they was saying it was hard for one person to live by themselves, or to buy a home or anything like that.
It's tough. I mean, let me jump on my calculator real quick. So 20, 40 grand divided by 12, 3,333 times 56.9%. That's 1896. So if they had no debt whatsoever, that's a $200,000 home, a little bit over 200 grand, 220, 230, somewhere up in there. Once you start throwing car payments in there, that's when it's going to start getting tougher. And most people who make 40 grand, they literally, it's the craziest thing. They buy some hefty car payments,
right?
$500 car payments. And I'm just like, that ain't what we doing. That ain't how we need to do it. But I mean, it's real out here. All we can do is just, really talk about budgeting and having side gigs. Mm-hmm.
Absolutely. I love this. This was amazing. We're gonna have to have Anthony come back.
Okay.
Absolutely. Yeah. I do want to share this. So once again, I did say my website is Ant.Holt.com. For my people who actually own homes, this year I'm trying to create millionaires. So I'm going to be setting up in person. I just bought some furniture where I can seat 20 people basically in my office. I'm going to start taking my education to a whole nother level. I'm teaching people about all the different types of investment property loans. I'm teaching people about how to leverage their home equity line to become millionaires, and start investing in property. How to eliminate debt. I'm just trying to put people in a much better position than what we were last year, the year before. I really feel like, things are about to get a little hectic. Y'all know what I'm saying. 2024 is going to be a little rough towards the end of the year.
Right.
But I'm just trying to do my part, to leave my legacy. And that is in the education piece, leaving us in a better condition, at least financially, than where we were in 2023. So follow me.
I love that.
Yeah.
So you think it's wise to use home equity lines towards debt?
Absolutely. Okay. Absolutely. If you
we're gonna Leon, we're gonna put his website and his email down in the description box. So
okay, yeah,
absolutely. It's an investment. That's an investment vehicle. Like check this out, y'all. If y'all want hear some or read some mind-blowing stuff, look up the history of FHA. One of the most racist, mortgage products. Those products were built to put folks in that don't look like us into, they created suburbs. Mm-hmm. And if you look at some of these old photographs of these neighborhoods, these rows and just like they do in neighborhoods now, rows and rows and rows of homes, right? This is how people created generational wealth that we don't have. The investment vehicle was actually the home. That increase, using that equity to then, some people use the equity to move up, to the next home and the next home. And then they leave that final home to their kids. Other people, life insurance, $1 million policy, once I croak, you got it. So with that being said, it's up to us to get beyond this fear of mowing grass and thinking about what am I going to leave for my children and my legacy, and what's the easiest way to get out of this generational wealth curse. And it's home ownership. You just got to do it the right way.
Yeah, I think you answered this question. Somebody asked, "Do you see the Feds lowering interest rates in the near future?"
July.
I think you said about
they're not. Yeah, they're not going to do it in March. We were hoping that they would do something in March, but we're thinking in July. So if you're looking to purchase a home, start now. try to get in there before then, because once July hits, depending on we speculate, and some people say, you know, that 5.5 is the magic number for everybody to get off the fence. And if that happens, that's going to drive up the cost. And it's, you know, we already really don't have much inventory as it is. People are going to be in multiple bid situations, and it's going to be all about who has the biggest, what we call due diligence payment, which is basically non-refundable monies. Y'all can look that up on Google, due diligence payments. It's like a deposit. It is a deposit, really. It ain't like, it is a deposit.
Right.
On real estate here. And then they're going to be making, I literally heard back in the day, these investors were making due diligence payments that were the same amount as the purchase price. And then they would come back to people like me and then get approved for the loan. So basically, let's say the home cost $300,000. They would literally take $300,000 and say, here's my due diligence payment. That's basically a cash offer. You're not going to beat that. That is non-refundable money, basically. $300,000. I don't care what's wrong with the house. You got it. And then they come to me, and as an investor, they do 80% financing or 85% financing. And then when they go to closing, I'm going to give them whatever that amount is, 85% of whatever the sales price is, as a loan. So they beat you to the punch. They basically told the seller they're paying cash, which they did, and they're just going to do a loan and get that money right on back in their pocket. And it's the craziest thing. So people, if you're interested in buying a home, get pre-approved now. And if you're aspiring and you think you have some issues, apply now. You know, so if you want to work with me, like I said, my website is my name, Ant.Holt.com. All you do is click apply now. I have 2 assistants and a processor. We're going to pull your credit. We'll tell you, we're going to call you to ask you what you're trying to do, you know, what kind of money you're working with, what you have access to, what your time frame is, and then we'll advise you. But, you know, like if you have credit issues or things that we need to work on, right now is the time to do it, because you do not want to start at the last minute, like when your lease is about to end, and then come to me and say, hey, I want to apply for a mortgage. Nah, bro, you should have did that 6 months ago. You knew your lease was going to end. I could have been working with you on all these credit issues that you got right now so that you get approved or clean your credit up so that your interest rate is super low.
And when it comes to refinancing, the credit don't matter, do it?
Absolutely. It's a loan. Yes. Yeah. You got to think about it.
For the ones who was already in the home.
It don't matter. You got plenty of people that are in their homes that, like, remember I said this person been in their home and ain't paid for 55 months.
Yeah.
You think I'm about to refinance that?
Yeah.
We're still looking at your income. It's still a loan, and you have to show your ability to repay that debt. So, man, at the end of the day, you could have quit your job, and that has happened. Renee, I have had people literally think that we're not going to verify that they're still employed before we close on their purchase loan. People, when somebody pre-approves you, that does not mean that you're done. We're going to go through a whole entire process, and we're going to make sure that you still work where you work. Until you get them keys, don't change anything. Don't buy a new car. Don't open up new credit cards, new debt. Don't do it. Don't quit your job.
Don't put furniture on hold.
Don't put furniture on hold. Don't do it. Don't do it. Don't change anything. Put some gas in your car. You're going to run up that credit card. Let it be for gas. Don't go doing a whole bunch of crazy stuff. I had a guy literally buy a whole entire Mustang and think we wasn't going to figure it out. I was like, bruh, the inquiry is right there on the credit report right here. We have a form that says it's asking you, what is this inquiry for? Oh, shopping for a car. I was like, all right, cool. We do what's called a quick look before we close. Joker had a whole full car payment up there. And we was like, he was a veteran. And I was like, he was a young guy. I was like, listen, man, I'm not telling you what to do. I said, but young man, if you think you're about to commit mortgage fraud, that's one thing. I said, but you about to commit mortgage fraud against the VA.
Oh,
you want to do that? As a veteran, you sure you want to do that, Playboy? Change your life.
Yeah. He'll never get that certificate again, because that certificate is
Mortgage fraud is one thing. Mortgage fraud against the government is something else.
Mm-hmm.
And you're a past employer. So yeah.
All right. I don't have any more questions. You got any more questions, Renee?
I don't have any more. I thank him. I thank him for
a lot of
his wisdom and everything that he brings to the table.
Appreciate you. I appreciate the time.
I see Anthony. If I'm out, he already know.
Yeah.
When I see him.
Let's go. You know I'm gonna be somewhere around Durham and Raleigh.
Yeah.
Somewhere.
We gonna have his
you got driving that Honda now. You good?
Oh yeah, I'm good. I'm really driving Miss Daisy. It might pass me.
Yeah. We're gonna have his information below. Reach out to my boy. Let him educate you. Answer all the questions that you have. If you're looking into home ownership, I highly recommend it. Myself, being a homeowner myself, I think is very beneficial, especially within our community. We really need to start owning our properties. You see, he's holding up a book, A Guide to Buying a Home, period.
Yep.
Are you on IG?
He is on IG.
Oh yeah. Holt is at Ant.Holt.team, TEAM.
Ant.Holt.team. Well, we put all that in the Ant.Holt.
We're gonna have all of that in the comments. So all you gotta do is click. You'll find my book.
Yeah, I definitely respond much quicker on IG. Facebook, no ma'am, no sir. Don't I cannot put Facebook on my phone. No ma'am.
Too much.
Yeah.
It don't matter. I just text like, hey.
Yeah, exactly. I'm a texter. Like I don't mind responding by text. I am fine with that. Y'all can text me. You can put my number in there in that chat if you want to, Renee.
Yeah, I don't like emails.
We gonna do that, but listen, we can't help if the ladies flock. We just add the information. Now they reach out to you and they want to see a house, but they really don't want to see a house. They just want to meet up. Don't come back to MPL podcast saying you send trickeries this way.
Hey, look, he's a Q and a Scorpio. Don't come over here sniffing around.
Okay. Y'all heard here first, ladies. And he's gonna be the same way in person. I'm just telling you, that's just what it is. We thank you so much, Anthony.
Thank you for the invite. I appreciate you.
Appreciate you again.
Yes.
There you have it for another episode of the Impel Forward podcast.
Thank you.
Have a great one.
Peace.